I'm Larry Williams, and I'd like to welcome you to my stock and investing trading strategy that I'll be teaching to you today. And thank you so much for coming here, because there's so many more things to be doing today. After all, college football season has just begun, and I know there's probably chores at home you could be doing instead of being here with me on a Saturday. So thank you for being here. I appreciate it greatly, and I hope to really expand your education and understanding of the stock market, investing and trading today. I'd like to also thank Harry Martinez, who is our support guy, who helps us and helps educate you people and work with you as well. And above all, I hope all of you will thank my wife, Louise Stapleton, because without Louise, none of this would have ever taken place. Louise is not here, but Louise, thank you. I hope you hear that. She's just been phenomenal to work with you people as well as put up with me. So Louise, thank you. We're going to break this down in a couple of different sections today. We're first going to talk about the markets and timing of the market. Then we'll get into an investment strategy that does somewhere in the area of 20% a year. Some years it will lose money if the market's down. It isn't perfect. Hopefully we're going to show you how to sidestep those bad years in the marketplace. And so your average return is going to be a little bit higher than 20%, because you're not going to be in those bad years like 2007 and 2008. And I'm going to give you a really interesting idea about how to time the markets. Then this afternoon we're going to get into, actually you'll see what I'm doing with our $1 million. With this strategy, we will select the stocks that we will be buying at the end of September, because we're just about to a buy point in the marketplace, and I'll explain that to you. So we'll actually go in and do it, so you'll get to see this actually in practice. Then after we do that, we're going to get into the investing or the trading strategy, which is really unique trading strategy. I'm going to tell you the stocks to work on it. You'll be able to see how you can apply it yourself. It's a mechanical trading strategy, pretty easy to follow. And the nice thing about it, it works on just about every stock I've ever put it on. There are some stocks it doesn't work on, but generally speaking, it will work on most any stock that you're going to bring up. And you can always tailor it a little bit to the stocks in question if you have some stock you're particularly interested in. So that's kind of where we're going. If you have questions at any time, feel free to ask the questions. Questions are more than welcome. I think it really helps us have dialogue. And with that, let's get started. I've been looking forward to this. I'm really excited to show you what I have to teach you. So Harry, if you'll go to our first slide, please. If you need assistance, you can go to Louise or Harry. Lunch will be at the atrium. It's in the center of the hotel. Restrooms are outside. You've probably already found them. And Harry, again. There's the agenda. We just went over that. So let's go to our first slide, course materials. Oh, this is interesting. We'll post the course materials so you can download them. We wanted to give you a printed manual, but we went in and had about that many pages printed at Kinko's the other night. It was $45. To get the entire manual, which is about 350 pages, about $300 per person. So we said, well, let's see, download. Okay, download, we'll download for sure. So the manuals will be downloaded, and hopefully the camera guys will get this all recorded and filmed and placed and spaced together and all that stuff, and you'll be able to actually be able to watch that as well on streaming. And you can work with Louise on that to get your numbers for you. Of course, those of you at home, you should already have this by now, so you'll be okay with that. The seminar material will be a PDF. You will be able to print it out on your own, so you can do the printing in color or black and white or however you want it. The seminar PowerPoint slides you have, so you can follow along with me today. And I think that's it. Harry? Oh, the indicators, this is interesting. The indicators, we're going to be using some indicators for the trading aspect. And they're indicators that are unique to my work. We do have them in TradeStation. We'll give them to you for free. We will have them in NinjaTrader. How many TradeStation people do we have? Oh my gosh, great. Ninja people? Any Ninja people? We'll have those indicators for you late next week. They should be ready. At some point, we'll have them in eSignal, and that's really all that we can support right now at this point. It's just, you know, Louise, myself, Harry, and a programmer, and we just can't support all the softwares in the world. But we will have those for you, and they are, of course, free. And you can get that from Louise, or if you're at home, you've probably already gotten the information from us. This is more of the same. That's next one. If you don't use TradeStation, NinjaFear, if you don't use NinjaTrader or TradeStation, you're using Thinkorswim or another platform, the NinjaTrader platform is free, so you can get that for free with free end-of-day data. So that's an advantage. TradeStation advantage is they have really much better data. If you trade there, the platform and the data is free, and their commissions are really low. And though I don't get paid by TradeStation anything at all, I would suggest that the reason I really like TradeStation is they do a lot of educational events. How many have watched TradeStation online webinars? By all of us, right? They have over 1,000 online webinars you can watch on YouTube, etc. They really are the only broker that supports education for traders. So I think we should support them because they've done a lot of educational research. So that's always in the back of my mind with TradeStation. And Harry, let's skip again. So this is your great fear, everybody, about the stock market, right? A crash. Is that correct? The next crash is going to happen probably tomorrow. That's our fear, or maybe it's going to happen next week, but that has kept me back from making fortunes in the marketplace because of a fear of a crash. And if that's bothered me, I know it's bothered everyone in this room because we have just this huge fear of it's going to fall apart. And I really need to deal with that fear because one of the worst mistakes I've made in my life as a trader, as an investor, is not to trade or invest for the long run. I've been a short-term little nickel-dime in and out trader. Yeah, I've made millions of dollars, but I could have done a whole lot better had I really just thought, hey, you know what, in the long run, things get better. And that's kind of an interesting concept. Look at our cars today. They're better than the cars were when I was a kid. The tires came off, the tires didn't last very long. My gosh, in a car now you have, well, you have television, you have cameras, you can look in the rearview mirror and see where you're backing up. They're better. Everything gets better. I believe that we have evolutionary economics. Things get better. And as things get better, stock prices go higher because companies have new products, new ideas, we buy them, and there's a gradual upward drift of stock prices. But because of the way we're hardwired individually, we're worried about the immediate future, and a cognitive bias that we all have is to be bearish. My son, as some of you have worked with, is a psychiatrist trained at Johns Hopkins, and Jason's been doing a lot of work on this cognitive bias. And the cognitive bias that we all have, there's several major that get in our way of being successful, is we just love bad news. Because if I see that George's life is worse than mine, I feel pretty damn good. I like to see somebody suffering because I don't feel so bad. I say, hey, look at him, sweetheart, look how good we're doing. You know, we're down in the gutter, but he's way down in the gutter. We just like bad news. And think about it, when you read your newspapers, what are the headlines in the newspapers? They're all bad news. And we don't write good news about how many houses didn't burn down today. It's always the houses that did burn down. It's always negative news. So that permeates our thinking as investors because we are just bombarded with this stuff all the time. So it's natural for us to see the bad news. We don't really see much of the good news. If you're a financial analyst and you want to get on CNBC or Fox Network or Drudge Report or Huffington Post, it's real easy. Just predict a crash. And the more times you predict it and the more times you're wrong, it seems like the more times they bring you back on. So that's the bias we really have to try to overcome. And I want to try to work with you on that today because that bias is so powerful that it creates fear within us not to be successful traders, not to do what we should. Well, this is what happened. This is the type of stuff you see. The 2014 crash, 32 years in the making, the single trigger that will crash your investments in 2014. The disaster that's about to happen will blindside most Americans. 2014's come and gone. How'd we do? Did you get blindsided? No. Did the world continue revolving around? Yeah. The market go up? Yeah. Did it go down at times? Yeah. But all this crashy stuff, it only happens occasionally. It does happen. I'm going to show you how to tell when it's going to happen, but it doesn't happen as much as the newspapers and the purveyors of pessimism would have us believe. It happens maybe every 7 to 10 years, but it doesn't happen every single week. And if you would, Harry, I love this one. Scientists predict 60% collapse. He's predicting a 60% stock market collapse. Not only that, he's a scientist. And that was the dreaded triple top that we saw in 2011. Oh, the dreaded triple top that was going to top the market. Well, the market's someplace up there now. The dreaded triple top didn't stop the market from going a lot higher, despite a scientific prediction. I love this year. The horse that won the Triple Crown this year, what was the horse's name? I didn't remember. Won the Kentucky Derby. The scientists were also predicting it couldn't win the Kentucky Derby because of some scientific study, but won. So much for scientific predictions. Some work, some don't work. This is largely a game where the future is difficult to work with. And you just have to be careful of all these negative things, because they'll freeze us and stop us from taking action. So that's the trend of the stock market, ladies and gentlemen. Is that an uptrend or a downtrend? What do you think? You think so? Brilliant, isn't it? That's pretty simple. But I know some of you in your minds are, well, yeah, but Obama's president, we have a large deficit, and the Federal Reserve is in the marketplace, and all these things are happening, and now we're going to crash. Well, we may. But that's the crash of 1929 back then, to put that in perspective. The crash of 2008, the 2000, 87, 66, and 70, look where we are. We're higher. On a long-term basis, stocks always go higher. Not all stocks. That's the difference. Not all stocks. But fortunately, you don't have to worry much about stock selection, because the wonderful people at the Dow Jones Industrial Average put new stocks into the Dow Jones Industrial Average and take old stocks out. They did that recently. They put in Apple and Nike. When I started trading the markets in 1962, that's right there, I think there's only 3 stocks in the Dow then that are still in the Dow now. So 27 of them went out. So, and these are blue chip companies, so you don't have to worry about stock selection. I think right now there's 16,600 in some stocks trading in America. That's like trying to find a needle in a haystack, isn't it? To know which one of those 16,600 stocks. So my thinking is, well, let's just narrow it down to the Dow. So I've gone from 16,600 to 30 stocks. That simplifies it, doesn't it? And I'm letting the guys at the Dow do my stock selection. They've got a pretty good record here of selecting the good stocks. Now all I have to do is find the stocks in the Dow. And so I simplify my process. What I'm the most excited about in the material I'm teaching on investing is, I taught this to a friend of mine where we live in St. Croix, who's a dentist. And he said, you know, Larry, I need something simple. I do root canals. I don't have time to do all the stuff you do. I don't want indicators. I don't want to have to pour through balance sheets. I want something really simple. That's what I need. And that's what this program is about. Anybody can do this. It does not take a mathematical background. It's really simple. It doesn't take time. That's the purpose of this investment strategy. So would you repeat after me? The trend is up. Let's hear it just one time. I know you bear it. The trend is up. Oh, good. And you just have to keep repeating that. That is our mantra. And I know you're going to get all this shell-shocked of all these things, especially if you're conservative politically. Because the political pundits on the right side of the podium just are always, most always negative. Ronald Reagan was positive, Jack Kemp was positive, but there's so many of these guys that are all negative about everything right now. Ron Paul, a great libertarian who worked with Ron, admire him immensely, but he's always negative about the economy. But go back a slide if you would. But look what they bucked against. The trend is up. This is not going to change. The world gets better. Things move on. This is a great study from Fidelity, the world's largest brokerage firm, mutual fund brokerage firm. They looked at all their accounts to see which accounts did the worst, which ones had the worst trading records, and they were easy to find. The shorter you hold a stock, the more likely you are to lose money. Short-term traders lost the most money. They were the least successful of all the accounts. Then they looked to see which account did the best, and they were the customers who forgot they had an account at Fidelity. All they did was fall asleep. Oh, yeah, I have that account there. Wonder how it's done. They did the best. They bought stocks and held on to them. They weren't trying to get in and out. The in and out guys, they were the ones that didn't do as well. I mean, what a message. This is millions of investors. What a large sample size that is to see that. You got to be really careful because we do have this continual upward drift of stock prices, and that's what we're going to take advantage of. It's going to teach us when to get in, when to get out, and give us an advantage in the game. A few years ago, I was given the Market Technicians Annual Man of the Year Award in New York City, and Bob Pisani, you probably see Bob on the CNBC a lot speaking, Bob was talking about how the market, people are alleging it's rigged, and it's not rigged. I think it is rigged. The stock market is absolutely rigged. On average, it does, we'll go to our next slide here, it does, we'll get to that in a moment, but on average, it does about somewhere in the area of 10% a year. Year after year after year after year. That means it's the greatest money-making machine in the history of the world. You buy quality stocks, upgrade them a little bit, hold on to them, you do about 10% a year. You don't have to feed it, don't have to paint it, don't have to mow it. As long as you hold it, you may not have to pay taxes on it, and you let it grow. What a wonderful investment that is. So it is a rigged game in that we do have upward drift in the prices of stocks. And that's what we need to take advantage of, is the upward drift is there, as short-term traders can't take advantage of it. Day traders, how much upward drift can a day trader get in one day? None, right? This is stacked against them to make any money on a rigged basis on what's there for us to take advantage of. Well, if we do look at those bear markets, this is interesting. Since 1929, we've had 11 bear markets. So that's almost 100 years now. We've had 11 bear markets, about one bear market every 10 years is what we have. But in our cognitive bearishness that we have, we keep thinking, oh, this year we're going to have it. Every year there's a lot of bearish people. Every single year there's bearishness in the marketplace. But it only becomes effective about 1 out of 10 years. So if you're a consistent bear, you're wrong 90% of the time. So the Mark Fabers of the world are wrong almost all of the time. Occasionally they got a down move, and they go, oh, look how brilliant I was. Well, yeah, but the old adage, a broken watch is right twice a day. In the stock market, a bear is right about 1 year out of every 10. Not only that, this is the really compelling point about bear markets, is the longest bear market we've ever seen lasted 37 months. On average, the shortest was 3 months. They actually don't last very long. They're somewhere in the area of about 15 to 20 months. That's it, less than 2 years on average. So they happen. In fact, we'll go back to the big chart and you'll see that we do get bear markets and they get a lot of down move, but that was really only a year and a half. This was a year. That was October, basically. 66 was 10 months, 62 was a couple of months, 1970, that was a real bear market. That lasted almost 2 years. So they don't last long when they happen. And what takes place with investors is the further down prices go, the more bearish you become. And you really need to become more bullish, not more bearish. As prices go down, you're getting closer to the end of the down move and the time's about over. So don't exceed your bearishness. I have done that because I thought it would continue forever. Well, it doesn't. The truth is that they don't last very long. The average return since 1926 has been 11.69% on average. If you just bought and held on to the S&P 500 stocks, upgraded as they're upgraded, that's what you would have done. My wager is that's better than most of you are doing in your investments right now. And it's a lot better than you've done in real estate, even in selected California real estate, because you have property taxes, you have to paint it, you have to, all the things you have to do with property, insure it, all the cost of holding it are really high. The cost of holding a stock is nothing. In fact, you get rewarded if you hold dividend stocks. You actually get paid money for holding on to these good quality stocks. So that's the advantage that we have in this game, which is just huge. And we need to take advantage of that, and being bearish doesn't take advantage of it. It isn't going to happen.